there's a difference between a pre-qualification and a true pre-approval. I would encourage everybody to work with the lender that actually underwrites them in full upfront. That's what a pre-approval is. It's pre-underwriting you for a transaction. Interest rates have remained at record low levels, and in my opinion, are going to continue to remain at these levels for the foreseeable future.
Farley and Farley were receiving a lot of inquiries. What's going on with the mortgage rates? Are they going to continue to be this attractive? We're so excited to buy, but we don't know. Should we wait? Should we proceed? And we decided, why don't we ask the expert? So here we have today with us Chris Dematteis from EPM, Equity Prime Mortgage, and we are just thrilled to have him join us with some super exciting and interesting information to clear up all your questions about the mortgage marketplace. So Chris, we'll leave it to you.
Thanks, Mary Lou. Thanks for having me today. It's always a pleasure to be with you guys. As I've been in the mortgage business for 16 years now. Equity Prime Mortgage is a Fannie Mae, Freddie Mac direct seller servicer of mortgages. It means that we underwrite, fund loans directly, and then we recycle our money through Fannie Mae and Freddie Mac on a monthly basis and continue to write more loans for more people. What a crazy year it's been. Interest rates are definitely a hot topic, and they continue to remain at all-time record lows right now. I get a lot of questions every day about, how long is this going to last? What's driving it? So what I wanted to do is just take a step back to the beginning of the year. We saw interest rates fall to record lows pre-COVID, and COVID has changed the game along the way for interest rates. When March came about, COVID caused just complete market chaos. There were a few weeks where we were seeing interest rate swings of over a full point in any given day. And when you have that kind of chaos in the mortgage market, it makes it impossible for lenders to quote interest rates and really get a handle on what's happening. So to calm markets down, we had the Fed intervene. So the Federal Reserve came in and they did what they did at the end of the financial crisis in 2008. They started buying mortgage-backed securities. And mortgage-backed securities are the bonds that Fannie Mae and Freddie Mac securitize all the loans into every month when banks write the loans and sell these loans to Fannie Mae. They securitize them into bonds, and then they give us our money back so we can go make more loans. So it's the price of these bonds that control interest rates. And it's the appetite for these bonds on the market that really drive rates lower. It's a supply and demand issue. If everybody is buying bonds and everybody wants bonds, the interest rates they pay investors go down. The prices go up and the rates they pay go down. So what happens is in times of market chaos like March, the Fed will come in and just purchase all of the bonds. So what that does is it drives interest rate or mortgage bond prices higher, and it drives interest rates lower. And that's what's happened here. We were already in a very low rate environment prior to COVID. So there was already a record demand on the banks for mortgages. There was actually a liquidity issue. Banks only have so much money. So if everybody rushes on the banks all at the same time to purchase homes and refinance, they can essentially run out of money. So that lent itself to the mortgage market confusion. The Fed stepped in to level the playing field, calm markets down, and bring the market back to a point where interest rates weren't moving around so much on a daily basis, and put them back into a period of stability. So that's what happened. So the Fed stepped in, started buying all the mortgage bonds, and interest rates stabilized in April going into May, and they stabilized at all-time record lows. As far as where we are today compared to April, we're very, very similar to where we were in rate in April. There really hasn't been much of a change in interest rates all year. Interest rates have remained at record low levels, and in my opinion, are going to continue to remain at these levels for the foreseeable future. We have the Federal Reserve already announced that they're going to continue this strategy of purchasing these mortgage-backed securities on a continuing basis. They buy them every week. We can actually watch and see the volume of bonds that they're buying. And as long as they have their foot in the door here and meddling in the mortgage market the way they are, it's going to keep interest rates artificially low and keep mortgage-backed security pricing very high at these record high prices. So we see these interest rates staying put for the better part of the year and well into 2021.
So basically, with all your knowledge on the bond market and the interest rates, your projections are very strong that the real estate market should continue to move forward because these rates are really so tantalizing that, why not buy now and make these, solid investments?
Yeah, absolutely, especially in our market. It's been a very interesting year. We have, not only do we have record low interest rates fueling a massive refinance boom. Basically, anybody with a mortgage that's taken a mortgage out before March of 2020 is essentially in a position to refinance and save money. So there's a tremendous demand on lenders for refinancing. And then that demand has been exacerbated by the purchase market. It's amazing to see what's happened in the purchase market since March. You had record unemployment levels. We stepped into the worst recession since the Great Depression. Yet the housing market, especially here in New Jersey, has just gone through the roof. Limited inventory, multiple bids, and the volume of purchase activity has just tripled. We see a 300% increase in purchase loan activity over this time last year. A big part of that, we think, and what we see is people leaving the cities, people leaving New York, Philadelphia, Northern New Jersey, realizing that they can now telecommute, realizing that they can work from home. And we see a lot of relocation coming down to the Atlantic Ocean, Monmouth County areas, driving that purchase market. So that's great. And it's doing what you said, Mary Lou, it's driving up home prices. So we have limited inventory, we have record high home prices, and record low interest rates. So it's a perfect storm for a great opportunity to sell and a great opportunity to refinance and save money. One thing I will share, and just with your clients or any clients who are watching, just be prepared for a longer transaction. Everybody involved in a real estate transaction, from the real estate agents to the title companies to the attorneys to the county registrars that do the searches to the lenders to the appraisers to the home inspectors, they're all busy as a result of the market conditions. So the biggest piece of advice I tell people is when you enter into a transaction, when we could normally close in 30 days, we are seeing 45 to 60 days as a common transaction timeline for purchases. And unfortunately, because of the sheer volume of purchase transactions, which we as lenders will prioritize, right? Because we have contractual commitment dates that we have to hit, and people moving trucks and coordinating all that. The refinances have been not pushed to the back burner, but definitely not prioritized over the purchases. So the refinance transactions are taking anywhere from, at our company, 60 to 75 days. We're setting that expectation up front. Many lenders across the country are running 4 to 5 months on refinance transactions, and several of them have completely stopped taking refinance applications at all due to the sheer volume that's coming through the door. So just be aware of that. The timelines are definitely extended right now.
We are finding the same thing, that we need to prepare for longer closings. We are working harder than ever. We're finding that patience is a real virtue. And I see your EPM surfboard in the back there. I think everybody needs to get out there and have a little fun and get some relief too, because, between waiting for your loans or your refi and closing your transactions, you do need a breath of fresh air and it's been a very busy time, and I don't really see an end to it. It seems that it's very aggressive, and people are more than anything looking for the lifestyle change and looking for more peaceful, gentler type of life. And I think that's why we're even more inundated with activity.
I couldn't agree more, especially on taking a minute to remember what's important in life too. Every once in a while, you might not be able to catch me. I'll be in a board meeting, so to speak.
Yes.
But yeah, it's good for mental health to take a break. We have been so busy over the past 6 to 8 months.
Yeah, 100 important. It's super important to keep that balance. That's for sure. So I also wanted to ask you about your jumbo loans right now, and any challenges that are out there between standard financing and jumbo loans, or any challenges or advantages that you see or we should keep an eye out for.
Yeah, so jumbo loans are unique in the market. They are a loan product that does not get purchased by Fannie Mae and Freddie Mac. Okay, so it's called a non-agency loan, meaning that the agencies, Fannie and Freddie, won't purchase them. So what happened during COVID with the jumbo market was very unique and unprecedented. I said in the beginning that the low interest rate environment caused a massive run on the banks for refinancing. A huge demand for purchases started to spring up. And there was a liquidity issue with banks. Again, banks don't have an endless supply of money. So we have Fannie Mae and Freddie Mac on the conventional mortgages and Ginnie Mae on the government loans, the FHA mortgages, to recycle our money through every month and continue that mortgage process, that mortgage cycle for Americans. But the jumbo market's unique. So the issue is actually made worse by the forbearance announcement. Mm-hmm. You remember back in March, April, the government through the CARES Act announced that anybody with a mortgage could request forbearance through their lender. Forbearance is traditionally a last case resort. It's basically like you're sticking up the white flag saying, hey, I surrender, I'm going into a financial hardship, I'm not going to be able to make my mortgage payments, I need help. And typically, if you ask for that, we would require you to document the financial hardship. It's not something that we simply just grant to anybody. It's literally one step before foreclosure. So with the CARES Act, what it did was it just allowed anybody with a mortgage to request forbearance, and it required us as lenders to simply grant that forbearance without any question. So ultimately what happened was close to 10% of the mortgages in the country went into forbearance. And it's important to understand what that means for a lender. When a loan goes into forbearance, the homeowner doesn't have to pay the mortgage, but the lender still has to deliver the interest due every month to Fannie Mae and Freddie Mac, the government agencies that own the loans. The lender still has to pay the homeowner's insurance premiums for the homeowner. They still have to pay the property taxes. They have to keep the loan current. So what that does is creates a liquidity issue. It drains resources from the bank, and the bank literally starts to run out of money. So when that happened on such a large scale, the first area of financing to get shut down was the jumbo market. And that's what happened in March and April. We had lenders across the country cease jumbo financing. I had countless clients who were in processing, approved, ready to close on transactions, purchase transactions and refinances that simply could not close because we would not lend. So that was a painful time. Since then, the jumbo market has reopened limitedly. There are lenders now that are re-engaging and starting to lend again. We've gotten past the forbearance issue. There's been further guidance from the government on how to deal with that and basically backstopping lenders so that we didn't go insolvent. So we got past that scary point, and now jumbo financing has reopened again. That being said, it is limited still. There are limited investors. There's a limited appetite for jumbo paper on the market. But interest rates in general on jumbo financing are still very attractive. It's possible to get sub 3% interest rates on jumbo loans, of $1 million or more. Anywhere between 2 0.625 roughly to about 3.25, depending upon the cost associated with those rates. But that market has reopened.
Well, that's excellent. There's been quite a few challenges, and that's why it's so important to work with someone that has, the experience and the skills that you and your team do at EPM. One of the last questions I had for you was regarding, we have a lot of requests now for clientele that wants to develop new construction or they want to rehab. Do you have any interesting programs out there that you would recommend for that type of buyer?
Yeah, so there's three actually. Construction financing, if you're going to build from the ground up, mortgage bankers like EPM, again, companies that sell our loans to Fannie Mae and Freddie Mac, typically do not offer straight up construction financing. Your best bet to get construction financing from the ground up is usually a local bank or a regional bank. Ocean First, for example, TD Bank. These guys have great construction programs that are single close programs. You borrow the money, they give you an interest-only period for about a year to build the house, and then they convert that to a fixed rate for the remaining term, usually 29 years or 14 years, depending on what you opt for. If you are looking to purchase existing construction, which a lot of people are, again, there's plenty of opportunity to purchase a home and renovate it. There's two phenomenal programs for that. One through Fannie Mae called Homestyle. Fannie Mae Homestyle is a renovation program where you can purchase the property, and we would give you one single loan to buy the property from the seller, and then you provide a contractor estimate for the work to be done, the renovation portion of it, and we lump both together, the purchase price plus the cost of repairs and renovation, and then you put your down payment on that total sum, right? And we give you one mortgage. So that closes, you take ownership of the home, the seller is paid off, and then the money to build the renovation or handle the renovations is put into an escrow account. So you now own the house and you have typically 6 months to complete the renovation work with your contractor. There's a government version of that through the FHA called the 203K loan, which works exactly the same way. Again, money to buy the house and renovate it, one single loan, one-time close, fixed rate, 30-year mortgage, the regular traditional 30-year note, with the money set aside at closing to handle the renovations after you take ownership. Those programs are also very popular with existing homeowners right now who are refinancing, who want to renovate their home. Some people love their house. It is a hot real estate market. It's a great time to sell. It's a challenging time to buy, as you well know. So some people are taking advantage of those programs to renovate their existing homes as well.
I had one other question I wanted to ask you. How do you feel about the client that wants to submit an offer without a contingency in there for financing? And I know there's some risk involved, but because the market is moving so quickly and the pace is so competitive, we do have clientele that are like, I want to take the mortgage contingency out there and just, appear as though I'm purchasing the property without any contingencies. Do you have any thoughts on that type of negotiation?
That will definitely make the offer appear stronger. In certain markets, I'm licensed all over the country. We do a lot of business in California. We have every transaction I'm involved in California, the buyers are waiving every contingency. Appraisal, inspection, they're basically asking for 3-week, 4-week closes to try to make their offers as strong as possible. With waiving a home sale contingency, the biggest piece of advice I would say is work with your lender to make sure that, one, you can qualify for the new purchase transaction without selling your existing home. That's the most important thing, right? You want to make sure that that's not going to cause a problem in getting you approved to buy the new home. If you can, there's some advantages to not selling your current home. If you don't need the net proceeds from the sale for a down payment on the new purchase, there is a very limited rental market right now, limited rental inventory, and there's a high demand for rental properties. So we have a lot of clients that are opting not to sell their current home. They find the down payment funds elsewhere. Some of them borrow against retirement assets. It's a great way to come up with a down payment without selling your home. You ultimately pay yourself back when you do that, and the loan from a retirement asset doesn't impact your ability to qualify for a new purchase. But then they retain their current home as an investment property. They create an income stream with that as well. So it becomes an income producing asset for them, which again can help them with their overall financial picture.
Yeah, very clever and creative. So basically, if you're well qualified, there's not a great deal of risk, and if you work with someone like yourself at EPM and you feel confident you can move forward without contingencies, you would pretty much give the buyer a guide that this is maybe something you could look into negotiating.
Yeah, and it's very common actually. Once we underwrite them, and again, that's the key, right? So there's a difference between a pre-qualification and a true pre-approval. I would encourage everybody to work with the lender that actually underwrites them in full upfront. That's what a pre-approval is. It's pre-underwriting you for a transaction. But through that, if we can determine that you can carry both the current property and the new property together, and you're comfortable enough going into that scenario where you would have potentially 2 mortgage payments, maybe even for a short period of time, it will only help your chances in securing the bid on the purchase by going non-contingent. And again, in this market, maybe you list your house, you make an offer non-contingent, and while you're purchasing the new property, you keep your house listed. You can close on the new purchase without having to worry about your home selling. But in this market, we pretty much know it's just a matter of time before your home's going to sell. So maybe it closes before you buy the new house, or maybe you end up in a situation where you have to carry it for a month or 2. But as long as you're financially capable of doing that and comfortable going into it, I would highly recommend that to help secure the bid on the purchase, because it is such a competitive market.
I know, it's really, you totally have to be prepared, and we try to advise our clients with the best possible tools and ideas to make some of these transactions come to fruition, because again, the second a property's listed, we're on the move, or the client's at the door, let's go look. So it's definitely an interesting marketplace, and very stimulating for sure.
Yeah, one more note on that, Mary Lou. To prepare yourself, you hit the nail on the head. If you're going to enter the market as a buyer, the more prepared you are, the better. And aside from being a cash buyer, if you're using financing, the more work you can do with the lender before you make the offer, the better chances you're going to have to close faster. The stronger your real estate agent's going to be able to position your offer. So do that legwork up front. Go through the full underwriting with the lender. Get yourself as far down the road to a mortgage commitment as you possibly can. Because what that does is it puts the lender in a position to move fast. The only thing we have left to do when our clients find a house is essentially order a title and appraisal, right? The income, the assets, the credit portion of their approval have already been underwritten. So aside from maybe updating a pay stub or a bank statement, we have that piece already handled. And that allows us to close within 30 days, which is something else that, as a real estate agent, you know that'll entice a seller to accept an offer. Also, communicating to the seller that the buyer has already been fully underwritten, and stressing the importance of that, and the difference between pre-qualification and a full underwrite will definitely help make a difference.
And even, the initial steps in getting yourself approved, like reach out to an expert like yourself. And I'm sure you have team members that can look into people's credit and advise them, look, this is what you need to clean up your credit. So, in the next couple months, when you're ready to move forward, we can qualify you, and, you're not going to have a situation. So you really need to be mindful and, again, prepared to make something happen for yourself.
Absolutely. I recommend anybody looking to purchase a home contact us 3 to 6 months at least, 3 months if you can, prior to even looking at a house. This isn't like buying a car. You can't just go out over the weekend and come home with a car. It takes time. It takes preparation. Even if you have good credit, if you have a 700 or a 715 or 720 FICO score, that's very good credit. We can improve that. If we can get you over a 740, it'll ultimately translate to lower costs and better overall financing. So the more time you give us to work with you to get you in quote unquote shape for the transaction, the better. The other thing is you just never know what is lurking in the details with these transactions. So you may feel that you're extremely well qualified and will have no problems whatsoever, but underwriting has gotten tougher over the years. And you just never know until you go through it what we're going to find. So if there is a problem, we don't want to find out about it a week or two before closing. We want to find out about it 3 to 6 months before you even buy a house, so we can address it, put a plan in place to overcome it, so it just doesn't create a hiccup when you're actually involved in the transaction. It creates for a less stressful and much faster experience.
It's so important that for an initial step that, because for us, we have clients that come and they want to, capture the American dream. They want to find their first home, and, there could be an obstacle. So it's really prudent for the buyer to be directed to a, company like yours, so that they have the opportunity to clean up their credit and make sure when they're ready to negotiate, it's dreamless.
Absolutely. Hey, there was one other thing I wanted to just touch on because we get a lot of questions on it.
Okay, sure.
I just heard about this 0.5 point increase in mortgage markets. I get phone calls on it every day. Hey, I heard the interest rates are going up 0.5 point. I just want to touch on that for a second and explain what that is. So it's not a 0.5 point increase to the interest rates. It's a 0.5 point increase to the cost of the interest rates. Okay, and this is very important to make this distinction. Again, when we sell loans to Fannie Mae and Freddie Mac, they securitize them into bonds, right? We're selling them debt. So they take all that debt and they create a bond, and then they issue that bond on the market, and it trades across the world. So when Fannie Mae announced and the government announced a 0.5 point increase in mortgage pricing, what that meant is they're now charging us as lenders a 0.5 point, meaning 0.5% of the loan amount. Okay, so on a $100,000 loan, it means a $500 fee. They're charging us 0.5% more when we sell the loan to Fannie Mae. So ultimately, that just gets passed along to the consumer. Okay, so what they're doing is basically saying, we see a tremendous amount of activity and an increase in mortgages across the country due to the low rate environment. We see the banking system making tremendous profits, and we're going to take a 0.5 point of that for ourselves. It's essentially a cash grab by the government. Now, it doesn't mean that interest rates are going up a 0.5 point. There are 0.5% movements in bond price all the time. Okay, it's 50 basis points. So when we look at these bonds and we look at how they impact interest rates, if you look at my screen, you can see the two sections that I've boxed out. These show 50 basis point moves in bond price over a period of 3 days. On the first box shows a 3-day drop, and then over the following 7 days, it shows the bond market improving in price and recovering that 50 basis points. This happens all the time, okay? You will always hear people say rates go up and rates go down. Interest rates don't change, right? 3% is available today, it was available yesterday, and it'll be available tomorrow. What changes every day is the cost of those rates. And the cost of the interest rates is controlled by bond price. So as bonds go up and down in price, the cost of the rates change. So it is very common to see a 50 basis point move in bond price any given week. It happens all the time. So when the government comes out and announces that they're now going to charge lenders a 50 basis point additional fee, It's essentially the same as interest rates moving about an eighth of a point. So going from 2.875 to 3%, or 3% to 3.125%. Okay, and then the market fluctuations will bring the rates up and down again naturally. So I just want to stress, it's not the end of the world. It's the government literally trying to capture some more income and profit for itself, taking some money away from the banking system. It does impact interest rates slightly, but whether you get a mortgage at 2.875%, 3%, or 3.125% on a 30-year fixed rate mortgage, on the average loan sizes for conventional loans in Atlantic County and Ocean County, it's not going to make much of a difference in your monthly payment at all. You know, anywhere from $10 to maybe $40 a month on the most common loan sizes. So these interest rates are still at record lows. They are going to remain at these levels for, we believe, the foreseeable future. You will always see fluctuations. You know, interest rates don't stay static. You'll see some small changes, eighth quarter point moves up and down in rate. What the key to getting the best interest rate is ultimately working with your lender who's knowledgeable about the bond market and knows exactly when to take the rate lock. Locking your interest rate, you have a window of opportunity to do that during a purchase transaction, anywhere from the beginning of the transaction to 4 days before closing. And it's very similar to buying a stock. You don't just wake up in the morning and say, hey, I want to buy 100 shares of Google today. You're going to look at what the stock has been doing over the past several weeks and months and make an educated decision on whether you're going to buy the stock today, or maybe you're going to wait a week or two and watch it a little longer because it's dropping, and you're going to try to time that to buy it at its lowest point. It's the same thing when you take out a mortgage, when you buy a house. What you're buying is not a stock, you're buying a bond. So you want to be able to time that when bond prices are at their highest and when interest rates are at their lowest. So that's the key to getting the lowest possible interest rate. Right now in this market, interest rates are low. All banks are going to offer record low rates. Advertising online can be a little deceiving. Banks are going to advertise one rate. It's going to be the lowest possible rate that they can come up with. Just pay attention to the APR. The higher the APR, the higher the fees. So average interest rates today are right around 3%. There are lower rates available with cost. The lower you go in rate, the higher the cost. The lowest rate available on any mortgage of any term across the country is 2.25%. The cost of that interest rate is extremely high right now. Most people are settling right around 2.875 to 3%, paying between 0.5 point to 1% of the loan amount in fees. So that's just a little more insight into interest rates and where they are, and the 0.5 point increase that everybody's been hearing about.
That's extremely informative, and you really broke it down so it was easy to understand and really makes sense. Thank you. I appreciate that.
Sure.
The economics of it all.
No problem.
But again, Chris, thank you so much for being here with us today on Ask the Expert. We're thrilled, again, that we've had the opportunity to work with you over the years, and we'll look forward to doing business with you in the future. And we greatly appreciate your expertise. Thank you again, and have a wonderful day.
You too, Mary Lou. Thanks so much. I love working with you guys and look forward to another great year in 2021.
Absolutely. Here we come, 2021.